On January 28, 2021, millions of retail traders watched their buy buttons vanish and asked the same question. Who gets to decide when a market is too hot? A decade into the zero commission era, the fault lines of market plumbing were mostly invisible to casual investors. Brokerages sold speed and slick design. Market makers monetized retail order flow. Clearinghouses sat in the background, ensuring trades settled and collateral was posted. Regulators argued over whether payment for order flow and fragmented venues made markets more open or more brittle. When a small video game retailer suddenly became the focal point of a coordinated buying rush, that hidden infrastructure took center stage. And what stood at stake was not just money, but the credibility of rules that claimed to treat a student with a phone and a hedge fund with prime broker credit the same way. The cast formed quickly. GameStop, a brick-and-mortar chain in a digital era, offered a turnaround story, new leadership, and a possible pivot to e-commerce that was more hope than spreadsheet. Short sellers, professional firms that borrow shares and sell them anticipating decline, held large positions and argued fundamentals were deteriorating. Retail traders on a rowdy Reddit forum framed the trade as both thesis and mission. Buy and hold, force shorts to cover, and ride the squeeze. Brokers courted this cohort with slick apps and free trades. Market makers internalized a huge share of retail flow and paid brokers for it. Clearinghouses recalculated collateral as volatility surged. In the United States, the Securities and Exchange Commission, the Financial Industry Regulatory Authority, and the Depository Trust and Clearing Corporation were the referees, each responsible for a different link in the chain. The timeline moved fast. In mid-January 2021, discussions on Wall Street bets fused with rising interest across social media. The stock rallied, then vaulted higher as options activity exploded. Short interest had been elevated for months, and published estimates suggested it approached or even exceeded the tradable float, a setup primed for a violent squeeze if momentum persisted. As the price surged, brokers raised margin requirements, and clearinghouses re-ran their value-at-risk models, marking up how much cash brokers had to post to stand behind customer positions. On January 28th, several retail-facing brokers restricted purchases in a cluster of volatile names and allowed only sales. The stated reason was operational. Clearing deposits had jumped so sharply that limiting exposure was, according to their accounts, the only way to keep the system solvent through settlement. Lawsuits followed within days. Congress set hearings for mid-February. The securities regulator said it was monitoring the situation and reviewing the conduct of regulated firms. By March, the immediate firestorm had cooled, but investigations and litigation were ongoing. Mechanically, the episode was a collision of known forces. Short selling begins with a borrow. Shares are located, lent, and sold, with the short hoping to buy back lower and return the shares. When prices rip higher, lenders can recall borrow, fees can spike, and brokers can increase margin. If a short cannot post collateral, it must buy to cover, which forces the price higher still. Add options to that. Retail traders bought large volumes of short-dated call options. The market makers who sold those options hedged by buying the underlying shares. As the stock rose and the options moved deeper into the money, hedging models required buying more shares to stay neutral. That feedback loop, call demand begets dealer hedging, begets higher prices, amplified the squeeze. None of this is illegal by itself. It is the math of risk management meeting a crowded narrative and tight supply. Payment for order flow sits beneath the surface. Free trading is not free. Brokers route many marketable small lot orders to wholesalers, large market makers, that pay for the flow. The wholesaler profits from spreads, internalization efficiencies, and the statistical predictability of retail orders, while promising price improvement to customers. Critics say the model embeds conflicts. A broker's incentives may not perfectly align with best execution, even if disclosure boxes are checked. Defenders counter that retail investors get tighter execution and zero commissions, and that reporting keeps the practice honest. During the squeeze, that debate turned concrete. If a broker depends on wholesale internalizers and must post deposits to a clearinghouse, what happens when collateral demands jump intraday and risk systems show red? Incentives sharpened every decision. Short sellers faced unbounded loss profiles. Several well-known funds disclosed bruising drawdowns and emergency capital injections. Market makers handled record volumes, but volatility cuts both ways. Maintaining continuous quotes in a whipsaw tape is expensive, and capital models tighten in real time. Brokers earn by routing orders and by lending on margin, yet both revenue streams assume normal collateral needs. When thousands of customers pile into one directionally concentrated, hyper-volatile trade, a broker's deposit requirement can jump by billions within hours. That is not a scandal. It is how the system is designed to prevent a failure cascade between trade date and settlement date. The question is whether those algorithms and haircuts are proportionate and predictable, and whether brokers that courted aggressive retail participation prepared for the tail event they helped create. Controls and failures mirrored those incentives. Many brokers used dynamic risk limits, but some were behind the curve. Real-time tools that normally flag clustered exposures were overwhelmed by speed and crowding. Stress tests that assumed order flow spread across thousands of names failed when retail traffic converged on a handful. Internal communications described urgent recalculations of deposit needs. Last-minute capital calls and risk dashboards toggled to reduce exposure now. On the short seller side, concentration risk had been signaled for months. Elevated short interest in a thin float is a classic squeeze recipe. Policies existed on paper. They failed in practice because behavioral assumptions were wrong. When everyone tries to exit at once, the door is narrow. Enforcement and litigation arrived almost at once, bounded here by late March 2021. The securities regulator publicly stated it was evaluating the volatility and reviewing actions by brokers, market makers, and the clearing utility. Class action suits accused brokers of unfairly restricting trading and causing customer harm. Brokers replied that clearing rules and their own risk policies left no alternative. Congressional hearings in mid-February summoned executives from a retail broker, a hedge fund that had taken losses, and a leading market maker in retail flow. Lawmakers pressed on payment for order flow, best execution, and whether social media coordination could amount to manipulation. Witnesses emphasized risk controls, collateral demands, and compliance with existing rules. State regulators opened inquiries into conflicts and disclosures. By March, motions to dismiss were on file in several civil cases, and the federal agencies emphasized ongoing review, but no final enforcement orders had been issued within this window. Victims and fallout were uneven. Some retail traders booked life-changing gains. Many who arrived late ate steep losses when volatility reversed. Short-biased funds suffered heavy damage, prompting redemptions and a rethink of models that had underweighted crowd-driven concentration risk. Brokers lost trust with a segment of their users. The choice to allow sells but restrict buys, even if grounded in clearing math, felt to many like the rules were rewritten mid-game. Market makers, though they processed record flow, faced suspicion about the structure of payment for order flow and their relationships with brokers. The broader market absorbed a humbling lesson. Sentiment can ignite faster than liquidity can absorb, and narratives can change risk parameters faster than quarterly board decks can update. There are durable lessons. Positioning matters as much as narrative. A company can have a weak business and a strong stock for a time if borrowable supply is tight and the crowd is persistent. When short interest is extremely high relative to float, the risk of a forced unwind reshapes payoffs for longs, shorts, and liquidity providers. Options are levers that move the underlying via hedging obligations. A surge in short-dated call buying can mechanically require counterparties to buy shares, creating a loop that feels like conspiracy but is really calculus. Free trading depends on a business model that performs in normal times and strains in extremes. If your broker relies on internalizers and must post deposits to a clearing utility, it has a kill switch, and in systemic stress, it may flip it. Leverage is gasoline. It helps you until the lights dim, and then it helps the fire find you faster. Treat social proof as entertainment, not evidence. If you join a crowd trade, define risk in advance, and accept that the exit is narrow. There is also a policy takeaway within the cutoff. The United States operates a fragmented market structure with overlapping authorities. The the securities regulator sets disclosure and market structure rules. A self-regulatory body polices brokerage conduct and capital. A clearing utility manages settlement risk and collateral. Shocks that arise from the collision of positioning, option hedging, and online coordination test each link. If you want more resilience, you can require brokers to carry more capital relative to concentrated retail flow, demand more conservative customer-level risk controls during abnormal volatility, or revisit incentives embedded in payment for order flow. Each path carries trade-offs: higher costs, tighter access, or lower broker revenue. Look at the quieter actors with clear eyes. Clearinghouses are not villains. They are machines that convert volatility into cash calls according to formulas. Those formulas are not omniscient. They react to historical correlations and stress scenarios and can overshoot when inputs are unprecedented. Brokers optimized for calm will lurch when demands spike. Short sellers are part of price discovery and corporate accountability, but when they concentrate exposures in fragile structures, they become fuel. Retail crowds are neither saints nor sinners. They are participants with real agency, real impact, and real exposure to whipsaw. For individual investors, a practical checklist helps. Before chasing a social media narrative, ask who will be forced to buy or sell if price jumps. Read your broker's disclosures on trade halts, day trade limits, and collateral calls. Prefer limit orders in hyper-volatile sessions to avoid the widest spreads. Keep position sizes small enough that a forced liquidation is an inconvenience, not a catastrophe. If you are short, be a professional pessimist. Small, hedged, and humble. Up to March 2021, the GameStop short squeeze was not a fable of little investors crushing titans or a noir tale of secret collusion. It was a stress test of a system optimized for benign times and retail growth. It proved that plumbing matters, incentives are sticky, and risk management often lags culture. It also proved that crowds can bend price far from value longer than models assume. Markets are not designed to be fair like sports. They are designed to clear risk without collapse. When narratives move faster than models, the system chooses survival over symmetry. You do not have to like that choice, but you should plan for it. If you found this useful, share it with someone who treats volatility like a vibe instead of a variable, and subscribe for more investigations that cut through noise and focus on mechanics before the next squeeze.